Good evening, all. Ira Epstein, and here we are with your metal market wrap-up. And this wrap-up is for Thursday, and we're at the 27th of July, 2023, just after getting on to 6:45 p.m. We're a bit late. Now, let me explain today. The markets were not ready for the strength that came out of the GDP numbers, the second quarter numbers. It wasn't ready for durable goods as strong as they were either. And for the labor market, again, to show that, number one, you keep dropping in the unemployment claims, and even the continuing fell. Those combinations overwhelmed the market. At first, the stock market went, oh, this is good. Look at how strong. Later in the day, profit-taking hit. But we're talking metals. And you got hit hard today because traders sat back and said, wait a minute, the economy is so strong. How can the Fed possibly come off center point and not go with another rate hike or more? That's what got the metals later in the day. You can read into it all you want, any which way, it won't matter. That's basically, in my opinion, what happened. The dollar roared on the news. The euro crashed on the news. Miss Lagarde came out today and she was as hawkish as Mr. Powell. In fact, you would think they were joined on an umbilical cord because when you looked at it, they're both data dependent. They'll do what it is. Every meeting's a live meeting, blah, blah, blah. But the overwhelming part is, number one, corporate earnings are not bad like the pundits wanted you to think. Number two, the economy is stronger than just about anybody guessed it was going to be. So when you look at gold, we've had a rally up to the 18-week average of closes or thereabouts, and the market got turned away. Now, this is the last quote right now. We'll see where the market finishes, but you're down 1% for the week. When we look at the chart today, you can come back a day here, and it is important to do it. Look at the size of this range. 2022, the market was humming until the good economic news came out, and then you crashed $40 in that market. Interesting. You can't get away from that. And what it does is it now gives you lower highs, lower lows. You're back into a downtrend. And where's the market going to fight a battle? I don't think there's a lot of downside is the point I'm making. The market got turned back at the 100-day average. Please go to yesterday's video. That's what I was saying at that point. Came back to the support number, the neutral number, the 18-day average. And yes, it's slightly under it right now by $7. It's early. If it wants to continue down, because you do have the trend down and the bias down, you have two numbers that could be where the market would go to. 1956, the Bollinger Band in black, 1951.90, or 60 it is, 1951.60, the 200-day average, and momentum is turned down. The bears regained control at this point in time. You don't want to be on this type of chart yet, in my opinion, bullish. When you look at the silver market, it rallied all the way up to, and it's right now fighting at the 18-day moving average of closes. If it crosses it, it would mean that gold is stronger than silver. And the higher the number goes, it means that each time you look at it, you need more ounces of silver to get 1 ounce of gold. That's what this represents. How many ounces of silver to get an ounce of gold? When you look at the silver, the market lost its embedded reading back here. Let me see if I can get this to, unfortunately, I don't know why it's not going to allow me to do it on this chart. This is what's moving. And I know I redid the chart. But you lost the reading back here, which correlates up here. It took a while, but you got to the 18-day average. That's what I was looking for with the lost reading. In the copper market, you have a market that went up in large part because Goldman Sachs, I had mentioned this, put out a longer-term price objectives on copper. In all fairness to them, longer term, they are saying if China does get something done, and they would jump the gun in terms of the property market, that copper is going to get a bid. That I agree with. The timing of it is what I didn't agree with. I think that they're right on that. Right now, you're about as neutral as can be. The trend is down with lower highs, lower lows, but you're over the 18-day average. Momentum had gotten overbought, and it's no longer there. A close underneath 383.85 would say bearishness, that's under the 18-day average, going home for the week. And then your risk would be back up to that high, and you open the door up between the Bollinger Band down here and the 18-day average. You're sort of in the middle of no man's land. In the platinum, you've re-entered the bear camp. Momentum down, lower highs, lower lows, under the 18-day average. So until today's high is taken out, let's see, I can't get it to go because it's going to work that only. I am still very much in the bear camp in the market, thinking that you came from here, you went up, challenged all these main moving averages, you're back down, but probably more neutral than really super bearish. And the reason is, as much as the chart is here, I think the market's just finding its way between that big rally and getting to a center point than anything else. The dollar, what a surprise move. Higher lows, higher highs. Now look for very serious resistance on the rally at 101.97. The funny part is I went out last night with one of my good friends and we were talking about the euro, and I was giving him the spiel, I'm bearish in the market, and gave him all the reasons why. Thank God I didn't have to pay for the dinner because I wouldn't look very good right now, but we're talking longer term anyways. And today's numbers, no, they're impressive. Mark on the charts today's low. You have an outside day. Outside days are super important. Often, they're a continuation pattern or a pattern where you're getting a reversal. In this case, the market had been going up, you had a small break, and you came back up with a large outside day. If this low is taken out in the next 2 trading sessions, then I think you've got a trap for the bulls and you're coming back down here. If it holds, I think you make a run to the closest main moving average. It's what I teach in my outside day course. And what you're always looking for in things like this is edges. And you're looking for patterns that give you an idea of something that might happen. Now, what I did with this is the idea that spiders, stocks, ETFs, a pattern's a pattern. It doesn't care what chart it's on. And more times than not, what I've learned in my long career is that an outside day is a continuation pattern. I put together 9 chapters and I explain that, but then I show you what happens if you violate that outside day. Does it work all the time in terms of trying to say what it's going to do, what it isn't going to do, how it's doing it? Of course it doesn't. But it's simple enough to learn. 9 chapters, you're going to get this on a Saturday, for example. So you go to iraepstein.com. Under the word education is this course. Take a look at it. It's all explained there for you. You can move your cursor to the top up here, give that a click, and get in line with that. I'm Ira. I'll see you tomorrow. Have a great evening.